All right, let's stick with us and get another perspective here. Fed Chair Powell wrapping up his press conference just minutes ago after the Fed decided to hold rates steady. Stocks rallying on that news, and Powell admission that the Fed is talking about timing of rate cuts. Here to discuss is Dr. Ed Yardeni, president of Yardeni Research. Dr. Ed, it's great to see you. Let me start with just getting your reaction, your response, Ed, to what the Fed did and said today.
Well, it was all very rational, very reasonable. It was a correct assessment that the economy is slowing. It's not going into recession. And most importantly, there's evidence that inflation across the board is continuing to moderate. It still remains above the Fed's target. But if you take out shelter, the CPI inflation rate was basically at where the Fed wants it to be at 2%. And we know that shelter inflation is going to be coming down. So not really that much of a surprise. I think it was a bit of a surprise that the summary of economic projections maybe went for 75 basis points as the drop in the Fed funds rate next year instead of 50 basis points. But the market loved it. I loved it. I thought that maybe it's turning out that I wasn't bullish enough because I thought we'd get to 4,600 by the end of the year, and here we are at basically 4,700.
Man, so Ed, everything is fantastic. Is that where we are right now? I mean, is there a risk? We talked to a guest earlier, Andrew Levin, who is an economics professor at Dartmouth, who said, we still have to be on the lookout for particularly services and shelter inflation not cooling down more. And while, of course, Powell said they're attentive to those types of risks, he doesn't seem particularly concerned. Should they be? Is that something you're watching?
Well, I think that most economists have missed a very important issue when it comes to inflation. Most of them have thought that we would need a recession in the U.S. in order for inflation to come down in the U.S. But our friends in China and Europe did it for us. They've been having a recession. There's a shallow recession in Europe. There is a property depression in China. And China's been exporting deflation in goods. So goods inflation is not an issue. Yes, there's still services inflation that's an issue, but that's bound to come down. Rent is a laggard in terms of inflation indicators. So I think, again, everything kind of made sense. Let's just enjoy the moment and not get so negative about how everything could go wrong. I mean, for 2 years now, it's like everything's going to go wrong, and now it's finally everybody's agreeing that it's going right. Let's enjoy it for a day.
Ed, that's just good, solid life advice. Enjoy the moment, right? Let me ask you this, Ed. Given what you've been talking about, given that backdrop, when do you think the Fed could start cutting rates here? Billionaire investor Bill Ackman, he made some headlines, Ed, when I'm sure you saw when he said, listen, he thought they could start cutting as soon as the first quarter. Is that where you're at?
Well, all of a sudden, the Fed seems to be, dovish. I mean, that's really what this was all about. It wasn't even really much of a hint. I didn't hear too many hawkish squawks coming out of that press conference. It sounded kind of dovish. And so, I'm rethinking my notion of when the Fed might go easier on us, and it could very well be in March.
Why is this dovishness also feels like a sudden shift, right? Maybe not.
Yes, it does.
This is something that Mohamed El-Erian was threading about. I guess that's the verb that we use now. He was on Threads talking about that this is quite an evolution from his remarks just 12 days ago, is what El-Erian said. What happened, do you think? Why the sudden change?
Well, it really isn't that much of a surprise because Governor Waller, a couple of weeks ago before the blackout period got going, he said that he thought that if inflation continues to moderate, then the Fed would have to lower interest rates. He said, we don't need a recession to lower interest rates, just we get lower inflation. We don't want to be even more restrictive. Keeping the Fed funds rate here when inflation's falling means real interest rates are going up. And Powell basically acknowledged that. He said if inflation comes down, then the Fed certainly would have to consider lowering interest rates so that they're not even more restrictive.
And so, Ed, add it up for us, for investors who are watching right now, given your outlook on the Fed, the economy, Ed, as we head into 2024, what sectors in the stock market look attractive to you?
Well, I mean, today everything looks pretty good. Interest rate sensitives are doing well. Technology is doing well. Industrials are doing well. The bears have been arguing this isn't really a legitimate bull market because it's just 7 or 8 stocks going up and everything else is going sideways. And now I think what we're seeing is it is a legitimate bull market. It's broadening. Why couldn't it broaden? Which is what it's doing now, on the perception that the Fed really is done raising interest rates and might really lower interest rates. So I would say information technology is still going to be a leadership group. Financials, industrials. I think that's where I would place the bets. I've been placing my bets in that areas, and it's a good day for that kind of overweight.
And what does all of this imply for interest rates, right? Also, right, for the Treasury market, which has already been seeing this dramatic move in yields?
Well, look, I think the Fed is going to be lowering interest rates next year, but I don't think we want to get too carried away about 100 to 150 basis points. I think they might do 75. I think they might actually do 50 basis points. And why is that? Because I think the economy is going to demonstrate it's really quite resilient. Everybody's been talking about the Fed as though they've tightened aggressively, which they have. But I think the other point to make is that what they've really done, and I think he mentioned the word at one point, is normalized. I think he was talking about normalizing the economy, normalizing the labor market. But I've been talking about the Fed normalizing interest rates. They're back to where they should be. They're back to where they were before the great financial crisis. We had that great abnormal period of near zero interest rates from the great financial crisis to the great virus crisis. Now we're back to normal, where you can actually get a decent return on your fixed income securities, where the capital markets will do a better job of allocating where capital goes. And we were at these rates before the great financial crisis. Economy did well, stock market did well. I think we're going to do well up ahead.
And Ed, I want to get you out of here on this. Just some historical perspective. You've been an economist, a strategist for a while, Ed. You've seen a few different Fed chiefs come and go. I'm just interested to get your take on Jay Powell, the kind of grade you give him. What do you make of his performance?
I'd give him an A. I know that some wouldn't be that generous, but I think if you're talking about the past 2 years, I mean, he did recognize that the Fed was behind the curve on inflation early last year and scrambled to catch up and did a pretty good job of that. I think all in all, he's done a pretty good job. I mean, usually economists like to be contrarians by betting against the Fed. Oh, the Fed can't possibly be right. These clowns always get it wrong. But I think the real contrary has been to bet that the Fed will get it right this time. That's been my position. And I think they have gotten it right. Powell kept saying, I think there's a narrow path there where we can bring inflation down without causing a recession. And suddenly it looks like we're just about there.
Dr. Ed, it is always a pleasure to see you. Thank you so much for your time and insight today.
Thank you.